Folks, welcome back to the Real Men of Real Estate Radio show here on KCAA Radio. I'm your host, Patrick Franz, the Note Mentor, and I am back with my awesome guest, Desi Arnaz, professional investor turned fund manager. And we're talking about these mortgage notes. And right before we left for the break, it was like, why maybe mortgage notes might be something you want to take a look at to collect passive cash flow from real estate without owning the real estate, right? Forget about the headaches of being a landlord, the bad tenants and the toilet calls or the leaky faucets and all this other stuff. We get rid of that by owning someone's mortgage and collecting mortgage payments with interest every month versus rent payments with headaches every month. But Des was just breaking down, what's this idea of how this mortgage note, the promissory note, and why do we call it a mortgage note, right? It's because it's a promissory note backed by a mortgage. And that's what Desi was getting right into. And I'll let you continue with where you left off on that, Des.
Oh, excellent. Thank you, Patrick. Yeah, I can get kind of long-winded sometimes. But I'm so passionate about this. And I just wanted to make sure everybody understood what a mortgage is. Basically, a mortgage and a promissory note, think of it this way. You borrow money to buy the real estate, and then you sign two documents. One document says, I agree to pay you back the money that you loaned me. That's called a promissory note. It's like an IOU, right? I owe you money and I will pay you back. But then in order to put some teeth into the IOU, you pledge the real estate as collateral. You say, if I don't pay you back, you can take my house. And that's basically what a mortgage says. In legalese, a mortgage says, if I fail to pay you, you can take my house. And so that's what a mortgage and a note are. And when I use these terms, I use them interchangeably. So when I buy a mortgage, I also buy the note. When I buy a note, I automatically buy the mortgage. Okay, that's all that was.
No, yeah, and it's awesome, guys. So what we're talking about is taking someone's promissory note, the debt they owe on their property, and we're investing in that. And we're taking over this debt from a bank, from a fund, from whoever owned that mortgage payment prior. And we're able to buy this type of an investment and put a mortgage, someone's mortgage in our portfolio versus another rental house. Yeah. And so can you imagine, folks, the idea of there's a homeowner living there. Some of you folks who are homeowners know about this because as a homeowner, you've had your mortgage transferred on you from bank to bank. You've gotten a letter in the mail that said, hey, Wells Fargo is no longer who you pay your mortgage to. Now it's Bank of America. Well, that's called a mortgage transfer by way of the letter we receive as a homeowner. But in the background, the bottom line is Chase or whatever bank sold your mortgage to a different bank and they took over the remaining payments of your mortgage. And that's what we're doing on what they call the secondary market. So Desi was finding out years ago, it was like an epiphany. It was like, wait a minute, we can own someone's mortgage with a homeowner in place versus own another rental with a renter in place. So we forego a lot of the headaches and issues that can come along with being a landlord, but yet we're still getting the cash flow, which creates financial freedom.
Right. Patrick, I've never been more free. And you know what else is interesting too? I owned a bunch of rental houses. Well, to me, it was a bunch. I had 28 doors. Okay. That's some houses. I had 2 4-unit buildings and some condos, and I had 28 tenants. There was always something going on that I had to do. You know what I mean? Always. Now I have more than 100 mortgages, and I hardly ever have to do anything. I meet once a month with the people that help me service my portfolio. Once a week for 1 hour, and I've got it all covered. So literally my investment portfolio takes 4 hours a month of time. Whereas when I was a landlord, 4 hours, give me a break. I mean, it took me that long just to sometimes unclog a toilet. You know what I mean?
4 hours a day.
Yeah, exactly. Exactly. So this is just so much better, and people don't bother me when things break. And so for me, it was a really, really good fit. And so I transitioned over from being a landlord to being what I know you've called a lien lord. Since mortgages can be a lien on real estate, you call us a lien lord. I thought that was a pretty accurate title, and I like it. It's kind of cool too.
Yeah, lien lord, loan lord, whatever it may be, right? But yeah, it's just an awesome investment vehicle. And I hope for the people that have just listening to my show for the first time that you understand this, what we're talking about owning someone's mortgage and collecting mortgage payments every month with interest very passively. Because guys, if you're a homeowner and your roof leaks, whose responsibility is it? Yours. If your toilet breaks, whose responsibility is it? Yours. If your faucet leaks, yours. If it needs a paint job, yours. If the landscape, yours, because it's your house. You're in charge of that physical property, right? And those are the headaches that we take over when we become a landlord. The renter's not in charge of doing anything. The renter's in charge of calling you to say, hey, the toilet's broke, fix it.
Yeah.
Now, when you're collecting someone's mortgage payment, you don't ever have to go to their house and fix a toilet.
Never. No, I love it. I've not seen hardly any of the properties that I own. I'm sorry, I don't own the properties. I own the mortgages. I've not seen hardly any of them. They're all over the country, Patrick, because unlike being a landlord, I'm not locked in geographically like I was as a landlord. I need to be able to get to my properties. Here, I have them all over the country. And if I have to go someplace, if I have a property in that general vicinity, and let's say I'm visiting a relative over there, all of a sudden that becomes a business trip because I might be going out to check out look at one of my assets, right? And so I get to write that trip off. The other thing I wanted to mention too is that there's some things that I can do now to help homeowners that maybe fall a little bit behind on their payments or whatever, or if they're struggling, because I am the bank. I have the ability to take a payment, for example, put it on the back end of the loan. I have the ability to rewrite the mortgage, lower their payments, extend the term. I'm the boss. And I love that. I'm able to help people stay in their homes when maybe a bigger bank like Bank of America might just foreclose on somebody. So it also gives me an opportunity to do good, is what I'm trying to say. And I like that.
Yeah. And, in talking to you in the past, there's really, there's two markets that you really can serve as a mortgage note owner, right? And one of those markets of people is the homeowners themselves. We have a responsibility that we're dealing with people's mortgages on their homes, and they have families, kids, they've been in the house for how many years, so on. And sometimes people can get themselves in financial trouble. And when they go to call a Wells Fargo or a Bank of America, there's 17 gatekeepers to get to the proper person who you're just a number to them. They don't really care about you when you're talking to Wells Fargo. You're just a number amongst millions of mortgages they own. You're just one. Well, that's so cool. That as a private or a singular mortgage note owner, you can have a much closer tie or a closer relationship with the story of that asset and that homeowner and their pay history and all of that. And so we can serve these homeowners by doing things to help them that maybe a big financial institution maybe wouldn't do for them. So this is a wonderful thing, helping families, keeping people in their homes, helping them avoid foreclosures. And this is all a great power and responsibility that we have now as a mortgage note investor. But we also forget too, folks, there's so much money running scared. Okay. There's money running scared from the stock market. People are afraid to invest in real estate now at the height of the market. If they know what happened in 2008, the home prices don't always just go up. Okay. Yeah. And there's people running scared of the money that's sitting in their IRA or 401k, because it could be kind of attached to the stock market or related to that. And when the stock market drops 40%, maybe their IRA or 401k does the same thing. And so there's another market of individuals that we can serve as note investors here, and that is other fellow investors, right? Other fellow investors, to allow somebody the opportunity to get their money involved into an investment that is secured by real estate, very passive, spits off cash flow, and has a nice ROI or a nice yield to it. It's hard to find all that in one investment when you compare it to other things like the stock market or cryptocurrencies and things. Yeah. So you serve homeowners and you help people, really good people in good communities that otherwise maybe would have been tossed aside by the big bank, but we can help and step in and help families. And the other point is we can help friends and family and other colleagues around us that maybe want to get their money out of something that they're afraid of and into something that is a little bit more secure. And this is two different markets we serve. Now, you started doing that, didn't you, Des? It's not only you started buying some mortgage notes and figuring out that great responsibility you have to help these homeowners out when you can, but also then it was like, well, you were buying notes and you ran out of your own liquidity because you bought so many notes. So your money's deployed. And now it makes good sense for you to help other investors who have the money to get involved in some of your deals and that spawned to some need of growing that. So let's talk about that a little bit.
Yeah.
And you started investing with some partners and bringing them into singular note deals. How does that look? And what does that do for an investor, maybe a friend or a family member of yours?
Well, it's interesting that you should bring that up today, Patrick, because my very first buddy that became my very first partner in a note deal called me yesterday. I hadn't spoken to him in about a year, really. We still have stuff together, right? We still have 2 deals together that we are partners on. But we just never talk to each other. We get the money back and forth, but we just haven't. He just happened to call me yesterday because he's coming down to San Diego. He lives in Idaho. He's coming down to San Diego. He just wanted to make sure that I was going to be around when he and his new wife come down. But he had come to me because he had sold his trucking company and he was sitting on some cash. He was retired, 69 years old, and he wanted to put that cash to work. And when he came to me, I helped him get some of that money invested into mortgage notes, and he loved it. But he came back to me and said, "Hey, Desi, let's do some deals together." And that's when I said to him, "Look, I don't have any cash. All my cash is invested." He goes, "I'll put up the money if you'll just manage this thing, because you know all about notes." And so that was my very first partnership, where I worked with someone else, where he put up the money and I did the management, and we owned that note together. And so that started me thinking there are other people out there that might want to do something like that. And so I started doing partnerships with other people by simply literally just saying, "This is how note investing works. Would you be interested in putting money into this type of an investment?" And people turn around and they look at it and they go, "Well, duh, yeah, get it out of the stock market, right? Get it out of the real estate market where it could go up, it could go down." The good thing about notes is that every single day interest gets added to the balance, right? Every day. So it's not like you got to worry about losing money because these people owe you interest, and the real estate is the collateral.
And I'll tell you what, I mean, I hate to do this when Desi's on a roll, man. I hate to do this, but we do have one more commercial break to go to. And I know that you won't go anywhere, listeners, because we'll be right back after this commercial break to talk more with Desi Arnaz about the transition to professional investor over to fund manager. And we'll get right to it. We'll be right back, folks.